we are hard to beat. So we are the 5th largest economy in the world. We'll be 3rd largest by the end of this decade. I want to get rid of this myth that higher debt to GDP is a problem for India, because
Ankita Pathak is a leading economist with over 7 years of experience in Indian markets. She simplifies complex macroeconomic concepts, helping investors make better decisions. Today, she's here to break down macroeconomics and its impact on your wealth.
Even for global investors, India and US are the 2 safe economies, because
news headlines that people read when Donald Trump was elected that he was going to impose high tariffs on US imports. How do things like that play up in terms of impacting investment decisions? Top 3 macro trends that you think are important for India?
I would say
So thanks so much for joining in. Let's break it down with the basics. Let's understand macroeconomics and how investors should keep all of this in mind when planning their finances.
sure. So before we start how it's impacts personal finance, let's begin with what macroeconomics is and what it entails. Okay, so in my head, it's basically 4 things. Number 1 aspect of macroeconomics is the health of the economy, which is reflected in the GDP numbers, of course, but there are a lot of high frequency data that comes out every month, where one can understand the economy that they are in. Is how is it progressing, is it expanding, is it contracting, and within those broader economy, are there sectors which are doing better or not doing so well? So high frequency, we usually say like GST bills, e-way bills, consumer confidence index, auto sales, rural wages, etc. So all of that culminate into one big aspect of macroeconomics, which I'd put it as health of the economy. The second aspect of macroeconomics for me would basically be fiscal and monetary policy, because economy and policy will always be related. Fiscal, of course, is whatever the government decides to do, how much they decide to spend on the country, and how they want to structure their expenditure, and also how they want to build their revenue, which basically is taxes, and therefore impact all of us in a wide variety of ways. I mean, never a doubt that before every union budget, the big question is, will the government slash taxes this time? So I think policy is the second big aspect of macroeconomics. The third aspect, and the growing one in the current context, is obviously the international trade and finance, how countries coexist on the world map. So we hear US-China trade wars, we hear US putting tariffs on Mexico, Canada. Could that happen on India? I think that again is a big chunk of macroeconomics, and the final portion of macroeconomics would always be societal issues. So when you talk about poverty, you talk about income inequality, K-shaped recovery. India is not India, is India 1, 2, 3 today. So I think all of that again falls into the purview of macroeconomics. I think within these 4 big boxes, there is a variety of issues that are covered, which affect personal financial planning. But if I were to give it away in one line, I think it's all about asset allocation and how you get it right. So macroeconomics equips you to choose between your asset allocation as the economic cycle is evolving. There are times when equity is better than debt, and there are times when debt is better than other asset classes. And 2024 was a year when gold was better than everything else. And the answer to these broader asset allocation trends lies in the macroeconomics, and therefore I think it's essential for financial planning in the current world.
So what parameters on the macroeconomic front do you think are important when it comes to managing your personal finances? What should investors watch out for on macros?
Sure, there are a bunch of indicators that are out there, but if I were to simplify for investors who are just getting hack of understanding macroeconomics for investing, I would say GDP matters a lot. Second is inflation. These are the ones which are directly connected to the financial planning journey. Third would be monetary policy. We all know the news we get around RBI, MPC. So I think that is important. And fourth, of course, would be whatever happens in the budget. Where is the government trying to spend? Which are the sectors that are directly benefiting? How much the government is planning to borrow? How will that get funded? So I think between GDP, inflation, and fiscal and monetary policy is where I would say the bulk of macroeconomics relevance lies. Of course, for our more nuanced investors, there are like high frequency data that comes out every month. But I think all of it eventually reflects into the growth numbers and into the decision making at the fiscal and monetary levels in the economy.
So, you have that ticker screen that goes that the GDP print or that the wholesale inflation number has come out. So, as an investor, I know you spoke of a few of them. What would be the pecking order in terms of importance when it comes to impacting their personal finance decisions or their portfolios?
So, I think the most interesting part of economics is that the textbook economics says ceteris paribus. The real world is never ceteris paribus. So it assumes that everything else staying constant, a high growth would lead to high equity performance, but everything else never remains constant, all right? So you're having a high growth and you're having high commodity prices at the same time, and that's taking away your equity earnings, and you can be sitting at a day when GDP is clocking high and markets are tanking, and vice versa, which we saw when the GDP print came out for the last quarter. So I think pecking order is hard to put down. But I have two cents. One, that market reaction to macro data is only when the data is significantly different from what the analyst estimates, street estimates or expectations were. So I think
either on the upside or downside.
Or on the downside. If it is as expected, markets are barely, they fall flat. And if they react, then correlation is not causation. The cause of that reaction could possibly be something else and not the macro data. So it's very important to understand that what is already priced in the market and what is it that this macro data is bringing in, which is incremental information which will get priced in. The second point here is that markets are a leading indicator per se, whereas macro data, by virtue of how it is measured and released, tends to be a little lagging. So I'll give you an example. We got the GDP in November for July, August and September. Now, markets don't care what happened, a quarter back almost, because by the time we're seeing the print, the news has changed from, the first half was bad, but in the second half, the government is expected to spend more, maybe a rate cut will come in, it's Diwali quarter, so growth will bounce again. And I think that plays a bigger influence on the market than economic data, which is lagging. So when we read those screens, as you said, like WPI or GDP or of it, we need to make sure that it is something that has a futuristic consequence. If it's a data of a past, it's best ignored.
So how do investors adjust themselves to the fact that India is currently, or adjust their portfolios, given the fact that India is currently seeing a transitory slowdown?
It depends on, how investors are planning time horizon of their investments, right? So if you're investing for next 10 years, how much should a transitory slowdown weigh on your portfolio? Because there are complications in investing with regards to taxation, the more you churn, the less you make, you hinder the overall compounding, etc. So I think my big advice has been to make sure that your decisions are aligned to your investment horizon. Having said that, I think the transitory slowdown that we saw in the economy, and generally when growth slows down, it becomes a little equity negative scenario per se, and we saw that in the earnings as well, that the corporate earnings don't grow well when nominal GDP does not grow well, or the GDP itself does not grow well. At the same time, the chances of RBI delivering a rate cut also increases when growth does not do well, because RBI is sitting on a dual mandate between inflation and growth. And while price stability is their bigger focus, if growth dwindles below India's potential output for longer, there is no chance, there's no way but to support the economy. So I think these two, and then you have to, I think, take into account the third factor, which has obviously always been the global macro. So if you think US is doing extremely well and India or emerging markets are not doing well, then that investing avenue opens up. And gold tends to do well when growth is not doing well, because gold is generally a risk-off asset. So we know all of this, and I think investors are acting in that direction. We can see that more people are opting for gold and have opted through to 2024 into gold as an asset class, as a risk again, as a hedge against growth slowdown that could possibly weigh on equity. So I think growth slowdown possibly demands some trimming of equity, and maybe if you still keep the equity portion to your risk appetite, it changes the way you approach investing. When you are in a high growth scenario, everything makes money, and we've seen that post-COVID. When you're in low growth environment, it becomes a bit of a stock pickers market, where companies which are delivering on earnings will still compound, but the index may be slightly sideways. So I think that approach of active versus passive becomes even more relevant in a low growth scenario.
How about understanding global economic trends? How important is that, especially when you're considering investing in international assets?
I think understanding global economic trends has become relevant both if you are investing internationally and even if you are investing domestically. I think last 3 months, whatever we've seen in the domestic markets also has been a function of the international activity that has been happening. So I think the world is very interconnected today, and that makes global economics a very important place to be in. I think there are 2-3 things that I would want to highlight there. One, in my opinion, it has always been US versus emerging markets as a trade. Okay, so I almost always read India versus China. China is taking away the FII flows, etc. I tend to disagree a little. I think over a long span of time, it's India and China, because EM as a basket is doing well. And when US does well, there is little incentive for foreign investors to chase emerging market premia, because they're going to make the same return in a developed economy like US minus the risk, and again there is a home country bias. So tracking US, I think, is an important part, and we always say there's this indicator called dollar index. It's called DXY in short. The moment it moves higher, it is bad for the EM. So after Trump, it has gone from 100 to 108 kind of levels, and we've seen a correction in all of the EM, including India and China alike. So I think tracking this one indicator alone reflects the strength of the US economy, and I wouldn't burden, of course we do it for a living, so we track like retail sales, employment numbers, consumer spending, credit card, all of it. But I think DXY is the most concurrent indicator that exists to track US doing well. So if US is doing well, I think getting into that space makes sense, and consequently it becomes a slightly negative for the Indian markets as well.
What about news headlines that people read when Donald Trump was elected, the fact that he was going to impose high tariffs on US imports? How do things like that play up in terms of impacting investment decisions?
They are very relevant, and I think I think I'm proud of a fact that these topics have now become a coffee shop chatter. So I remember being in a Starbucks in November, and people, just bunch of people saying Trump coming in is China negative. So people have seen a cycle of tariffs, and they don't take it as a passing news, but there's a whole lot of gravity that goes into discussing these issues. So that's of course a good thing. Now, second is that how does it play out? I think it's a little complex. Let me give an example. So Trump says 60% tariffs on China and 10% on rest of the world. China has been beaten down fully by equity investors in last 3 years, because this 60% is accounted for, going back to when I said what's priced in versus what's coming new. Whereas this 10% on rest of the world is the unknown unknown. They started with putting it on Mexico and Canada. They could target other economies still, and that is where the volatility in equity market lies, which is the difference from expectations. So my sense is that when Trump comes in, he will do some movement on the tariffs. Now, China, I think, is fully beaten down. It's fully priced in, and they are also preparing a fiscal stimulus to give back or retaliate their stance. And China is also trying to basically give back in a way, hit them where it hurts. So China knows that US is dependent on them for the semiconductor supply, and suddenly they have stopped the exports of trace materials such as graphites, which is very important for the chip construction. But US big tech depends on that. So I think this aspect is very interesting. Of course, there are consensus coffee shop views that gets created, but it tends to be a little more convoluted on what's expected, plus the retaliation that will come in. For international investing, I think it's important to be an asset allocator, one. So if there is a view, I think it's better to play it, but like play 70% of your portfolio, of your equity allocation basically, and hedge that other 30% with the contra bets. I think that's very important. Secondly, when these tariffs and all come in, equity volatility tends to go higher, and again, a safer asset class like gold tends to do better. So hedging your portfolio against these risks is important, because if we want those long-term benefits of wealth creation, we want to see the upside. But we want to be at a downside, we want to see the downside so much that we can still sleep at night. Otherwise, your behavioral biases kick in, and if the downside is extreme, you tend to sell in a frenzy, or you tend to make up a bad investing decision, which needs to be avoided. So I think for international investing, hedging is super important.
There's also been a lot spoken of in terms of government capex, especially with Modi 3.0. How does this impact investors? How should they read into this?
Of course. So I think infrastructure investing is super important in India. We did a study where we compared countries which have reached that 2000 per capita GDP, albeit China, Indonesia, etc. The next leg of growth came from infra spending, and I think India stands at that point after breaching that 2000 per capita GDP mark, and that will drive, I think, India's economy further. Now, how for investors, of course, if a capex is happening in a particular sector, the equity in those sectors become more attractive. So we've seen it in cap goods, etc., defense, etc., playing out well. That is important. And the second point that's important is that if government's going to do so much of capex, is going to borrow from somewhere, right, apart from the revenue. So where is that money coming from? And if the government is increasing its borrowing, then that means that interest rates will be higher, which means that RBI repo rate will inch somewhat higher, or your 10-year yield will inch higher, which means the loans become more costly, which in very technical terms we call crowding out because of the government spending more. So I think again it's a seesaw per se, it's a balance on where it goes. But usually capital expenditure is a good sign, because it's a multiplier effect on the economy, and it's non-inflationary. So revenue expenditure tends to cause inflation in the economy, it hurts the economy. And once you've committed to revenue expenditure, you have to, it's a sticky expenditure, whereas capex you can change as per the needs of the economy. So overall positive, gives you the sectors you can go into, non-inflationary, but still if not financed properly, tends to hurt the consumer in some ways.
Also, the debt to GDP ratio in India at about 57%. How do we stack up as compared to the rest of the globe, and what does this mean for investors?
So I think India's debt to GDP at 58% is fairly low. To give you a context, US is at 120% of GDP. And now Department of Government Efficiency, as it is called, is trying to, trying to reduce that fiscal burden, though economist consensus is that it will go up further. Let me just touch a bit on the US debt and then flip back onto the Indian debt levels. The thing with US debt is that when US debt tends to go up, because it holds the dollar, it is greenback is basically US's, they tend to finance it through QE, etc. It becomes very positive for gold, because it creates that inflationary regime in that economy. So US debt going up is a positive correlation with precious metal like gold. Now, because commodity prices are driven internationally, we can't say the same for India. So domestically, debt to GDP is has a very little asset class correlation, but still there are two caveats. One, 58% of the GDP, yes, but we borrow very less internationally. So of this 50%, only about 7 to 8% is in dollar denominated, rest is all INR. So I want to basically get rid of this myth that higher debt to GDP is a problem for India, because higher debt to GDP has been a problem for countries like Venezuela, Sri Lanka, etc., because it was more in dollar denominated money, and then they ran out of the forex reserves to service that dollar debt. In India, we have borrowed mostly in money, so it's not really a sign of vulnerability in the economy, because it's all in INR and we're not gonna basically not be able to repay or service that debt. So I think composition of debt to GDP is important. Which currency is it borrowed in? Even when we compare it across other emerging markets. So I think that's one. And second, I think at 58% we are fairly at the levels that we have been at, like good times as well, in like 2004-05, when we have seen a very good bull run. Indian corporates have deleveraged over the last 5.5, 6 years. So I think balance sheets are pretty clean. The banking system NPAs are down. I think overall our debt to GDP numbers are fairly in control, and my sense is that corporates will relever again at some point, when the credit cycle turns. But that's the nature of doing business, that you need to leverage up to expand. So there are no red flashing signs there.
So, when we read headlines like tomato prices are going up, onion prices are going up, that pinches our pockets for sure. But with CPI inflation around the 6% mark or having come down, food inflation, it's eased, but only marginally. It was in double digits not so long ago. How do investors hedge against inflationary pressures in their portfolio?
Sure. So I think one thing before I answer that is to realize is that inflation does eat away from your portfolio, right? So if you need, let's say, if you want to have 1 CR inflation adjusted 30 years later and inflation is about 4%, you only need to save about 3 CR. That's what it's converting into. But if inflation is suddenly compounding at 10%, that amount will become 17 CR in a span. So the 3 to 17 is a big jump that you see, and I think the more important aspect and what all investors should chase is inflation adjusted returns, because eventually whether you're doing your goal planning, retirement planning, it matters the most to have in the money that you'll have in future, it should be able to fund your expenses. So inflation adjusted returns are important, and therefore these inflation numbers are very important, because they're not only hurting you in the current terms by taking away from your income, since you're paying more for your needs, even for your future you need to save extra. Which is again hard to do, because at the same time you're paying more for today's consumption and you're expected to save more, and if your wages remain the same, it's a super hard problem to solve. Having said that, I think the ways to hedge against inflation, there are basically two big ways. One, that commodity prices tends to move with inflation, especially gold prices. So if you're living in like a inflationary regime, creating a space in your portfolio for commodities, and particularly within commodities, gold, because it's one of the safest commodities you can hold, adds value. Secondly, you need to realize that if it's a high inflationary regime, the chances of rate cuts are very low, which means your debt income would possibly not yield as much capital gains as we'd obviously like, and therefore unless and until it's a runaway inflation, taking a more calibrated exposure to equity, which is a higher return asset class, would make sense. So to beat higher inflation, I think a higher exposure to equity plus exposure to commodities, and especially precious metals like gold, is important. Now on my equities part, all I have to say is that equities love high growth and low inflation, but inflation between until 6 is still fine, but if we start having a headline above 10 or below 0, which is what China is fighting through. So hyperinflation and deflation are both bad, but this 2 to 6% is still a healthy rate of inflation to have. So while we are in that range and if the growth is solid, for sure we can marginally look at having incremental equity alongside having commodities as an inflation hedge.
What about government subsidies? You've got 80 crore Indians who are relying on these government subsidies. What are the long-term risks of this to economic growth and financial stability?
See, this is a very, I would say, view-based question to answer, and let me put it why. Because at one point we've accepted that post-COVID we've had a K-shaped recovery where the rich have been able to gotten richer, equity markets have been the best performing asset class. So if you were invested, you've basically doubled your invested capital in a span of 3 years, which is I think a huge number to have. So on that front, in a country like India, there's always been a support to the bottom pyramid per se in terms of free food, etc. And of course, it is also important that we don't create a society which leads to societal unrest, because a part of the Indian society is not well fed. Okay, so now having said that, from more financial and economic terms, a higher subsidies means again this number needs to be financed somewhere. So there are 2-3 ways. One is that either to fund this you will cut expenditure elsewhere. So what is the opportunity cost of this subsidy? Is it coming by cutting the capex, or is it coming from paying for something that adds more value to the Indian economy? So I think opportunity cost is very important. The second is, if this is getting financed by taxing, and taxation is usually done by people who are already salaried, employed per se, and again it becomes it very easily culminates into tax the rich narrative. And then third, if you are not taxing the rich and if you are not cutting it from somewhere, then you have to increase your borrowing per se, and which means you will invite higher yields in the economy, which means credit will gonna be expensive and consumption will continue to fall. So from pure investing and asset class allocation perspective, I think there's barely an asset class that benefits from higher subsidies. It brings down your returns on the portfolio. because it can be inflationary, it doesn't add to growth, leads to higher yields, leads to higher government borrowings. But I think we underestimate the impact it pays in India's employment, in India's GDP, and finally in the overall growth that maybe FII see for India, and which makes them wanting to invest in India. So I think that aspect is missed out, which is a more societal aspect. But I think it brushes off in the growth, and it gives the FIIs a conviction to invest in India. If its economy, which is growing at 7%, does not have social unrest, and it's beating poverty, and if you're eradicating poverty, you also become an investable demography and a geography to be in. So collateral benefits, but direct damages.
Yeah. What about employment? Because I think that's a big talking point. Under Viksit Bharat 2047, we have the vision of creating 10 million quality jobs. But there's still those problems and imbalances like underemployment in smaller cities. So how do we achieve these,
I
goals?
think employment is one field which is absolutely must for us to be a developed or walk down the path of development, because we talk about our demographic dividend quite a lot, right? So we have the largest number of youth compared to across countries in the world. But the problem is that these youth add to our strength only if they are employed. So non-employed or non-productive youth tends to be a drag. So then we can't call it a demographic dividend anymore. It's a demographic payout rather that it will become if we don't create those jobs. And there are problems with job creation, because even in like our industry, which is finance, the number of jobs that we roll out versus the number of finance graduates that come into the society as a whole, I think there's a huge demand and supply mismatch. So that and what has India seen is that we had a very short phase, I would say a little bit into 2000s, when we actually focused on manufacturing, which is a very labor intensive field. After that, we quickly switched into services, and we have been growing as a services economy all through even today. But services tends to be not the most employable industry to be in, because it's fairly asset light and human light. So I think we need initiatives, and the government is fairly doing it with like a semiconductor program or Make in India program, where India gets back to manufacturing, because manufacturing is a part or the segment of the economy where most people get employed. After construction, of course, construction employs the most number of people in India. So I think it's in a pecking order, it's agriculture, but that's usually people who have inherited fields, etc. And so agriculture, construction, manufacturing.
Given what's your future outlook is on India's macros, what do you think investors or individuals should do to align their financial strategy accordingly?
So I think in the longer term, we've been long India, and I think India it's a beautiful geography to have. It's a chaotic, it's commotion, it's always like work in progress, but it's always moving forward. So we are that slow and steady geography that on a longer term basis goes upwards, but in the short term feels a bit like a work in progress. But let me put this, that now we have grown to a size where we are hard to beat. So we are the 5th largest economy in the world. We'll be 3rd largest by the end of this decade. Now our momentum is in place. So we are adding about 100 lakh crores in the domestic economy every 3 to 5 years now. So we were adding 100 lakh crores every 5 years. If we continue to grow at about 10% also normally, we'll be adding that number in 3.5 to 4 years. That's a huge number that comes into our economy. So I think, like we say, momentum is speed into mass. First we had just the speed, we were growing fast, but we had no base. Now we are 300 lakh crores on the nominal GDP, we also have the mass in place. So that momentum is now in place, and I think Therefore, for investors, India is a favorable economy and will remain a favorable economy. I personally also think even for global investors, I think India and US are the two safe economies to play through because the foundation is very solid.
And like a quick answer in terms of the top 3 macro trends that you think are important for India.
The 3 macro trends that are important for India right now, I would say one is how do our corporates earn more from here, okay? So, we are seeing this trend of more IPOs, equity supplies increasing. Overall, the consumption pattern has not grown by so much. So, how does the existing corporates, get to their operating margins and get back to their earnings growth? Okay. I think that is super important. The second important factor is for India to have, we are kind of entering into a low growth, high inflation phase, again technically known as stagflation. Like we spoke that at the start as well, that GDP is falling, but it's the inflation that's growing. Now, this trend should not intensify. It can be a transitory trend, but if that intensifies, it's not something that's good for India. So, I think we have to be anti-stagflation, and we have to use the policy to fight out and get back to a decent inflation and a moderating economy. So, I'm not very upset on the growth part still, but the 6% plus inflation is slightly worrying. I think that's the second big data to watch. And the third is that we need to protect ourselves in the global geopolitics. There's a lot happening between US, Russia, China, even on the Middle East. And I think India has played very well so far. We've been diplomatic enough and we've maintained good trade relations across. But protecting ourselves in geopolitics will be very, very important for us to stand next to a developed market and deliver the kind of returns we expect US to give in.
Right. Thank you so much, Ankita, for talking to us. Really spoken a lot about the macroeconomic standpoint in India, and I think a few key takeaways are that when the macroeconomic data deviates a lot from what was expected, that's when maybe your alarm bells should rise. It is important to focus on the timing of releases, and your decisions should be aligned with your time horizon as well. The higher debt to GDP in India is not so much of a concern. Capex related sectors, of course, are slated to do well, and the government's focus on job creation is going to be very critical. But all in all, the India story looks very promising. What were your key takeaways from this episode? Do let us know in the comments section. Thank you so much for watching. Do remember to subscribe to Personal Finance TV, and I'll catch you in the next episode.